Welcome to America Door. Listen, we're about to reveal a concealed tax that is draining millions of American retirees of substantial money. If you're retired or even considering it, you absolutely must understand this. We're discussing the surprising way Social Security benefits get taxed, and for numerous people, this arrives as a total and very costly shock. So, let's dive straight into this matter. I have a question for you. Do you know definitively whether the IRS treats your Social Security benefits as taxable income? You know, it's not a straightforward yes or no response for everyone. And if you miscalculate, well, you could face a truly unpleasant surprise from the tax authority. You know, just last year, approximately 12 million seniors received one of those unwanted surprises. It arrived in an official-looking envelope from the IRS informing them they owed money they likely had already used. And it's all due to a regulation that, honestly, most people don't even realize exists. Okay, so here's our strategy. We're going to begin by truly grasping this tax snare and why it's trapping so many additional people currently. Then, we'll examine the seriously antiquated regulation that's creating all this confusion. I'm going to guide you through the IRS's hidden formula for something called provisional income. Then we'll observe how this unfolds with 3 different realistic examples. And most crucially, I'm going to provide you 5 clear, practical steps you can implement to safeguard your own money. So what is truly happening here? The heart of the issue is a system that essentially places all the responsibility on you to determine if your benefits are taxable. And currently, that system is ensnaring more people than ever before, all because the IRS has a new, powerful tool at its disposal. And this right here, this is what demonstrates the urgency. The IRS has, you might say, enhanced its computers. Their systems can now immediately cross-check your tax return with the information from the Social Security Administration. So what does that signify? It means even a tiny, harmless error gets detected automatically, and boom, an official notice is in the mail traveling your way. But wait, why is this affecting so many people all of a sudden? It's actually not some new legislation that Congress just enacted. No. The real villain here is a regulation that has been in place for over 3 decades, and it's never, ever been modified. This slide just presents it all, plain and simple. The income thresholds that activate this tax were established way back in 1993. Think about that for a moment. 1993. Congress set them at $25,000 for single filers and $32,000 for joint filers, and then they just kind of ignored them. They have never been modified for inflation. So, while your benefits and other income have increased over the years, that tax threshold has remained fixed in time. And look at the outcome. It is absolutely shocking. Back in the year 2000, only about 18% of retirees paid any federal tax on their benefits. Fast forward to today, and that figure has skyrocketed to over 56%. And let's be clear, it's not because retirees suddenly became super wealthy. It's because this tax snare, this immovable line in the sand, is getting nearer and nearer to everyone. You know, this comparison from one of our sources is just perfect. Imagine your landlord offered you a fantastic deal on rent back in '93. Now, over the years, you receive cost of living raises at work just to keep up, but your landlord never modifies your discount. Instead, they just notice your bigger paycheck and they think, you can obviously afford to pay me more. Well, that's exactly what the IRS is doing. Your annual cost of living adjustments for Social Security are treated as new income, pushing you right over that old, outdated tax threshold. Okay, let's get into what is probably the most essential part of this whole discussion, the IRS's hidden formula. See, to determine if your benefits are taxable, they don't use the normal income figures you're accustomed to seeing. No, they have this special, and let's be honest, kind of confusing calculation. It's called provisional income. And here's the kicker. You are not going to find this provisional income figure on any of your standard tax forms. It's not on your 1040. It's a special formula that the IRS uses only for this one purpose, and it's up to you to determine it yourself just to know if you're in danger of being taxed. So, here's how you actually calculate it. And don't worry, the math isn't that difficult. It's just 3 simple steps. First, you take your adjusted gross income, your AGI, right from your tax return. Second, you add in any tax-free interest you might have, like from municipal bonds. And third, and this is the strange part, You add in exactly 1/2 of your total Social Security benefits for the year. Add those figures up, and that's it. That's your provisional income. Okay, so you've got your figure. Now what? You take that figure and you see where you land on this table. If you're a single filer and your provisional income is under $25,000, congratulations, you're in the clear. But if it's between $25,000 and $34,000, well, now up to half of your benefits can be taxed. And if you're over $34,000, the IRS can tax up to 85% of your benefits. For married couples filing jointly, the figures are a little higher, but the painful logic is exactly the same. All right, enough with the abstract figures and tables. Let's see how this actually unfolds for real people with real budgets. Because when you see the impact this has on somebody's actual life, it really hits home. So, first up, let's meet Margaret. She's 71 years old and lives on her own. And like so many people, she just assumed her Social Security was her money, plain and simple, and that it was safe from taxes. I mean, she has a small IRA and a CD, but she never in a million years imagined that they could put her Social Security benefits in jeopardy. Let's do the math for her. Her AGI from that IRA and CD comes out to about $11,800. She doesn't have any tax-free interest. Half of her Social Security benefits is about $12,300. You add it all up, and her provisional income is just over $24,000. Now, that puts her just barely under that $25,000 threshold for a single filer. So, she was safe last year, but just by a hair. A tiny increase in her IRA withdrawal or a little bump in interest rates could easily push her right over the line next year. Okay, now let's meet Robert and Linda. To help make ends meet, Robert picked up a part-time job down at the local hardware store. You know, it helps with groceries and gas. But they had absolutely no idea that that little bit of extra cash would have such a massive impact on their taxes. So, let's run the figures for them. Their AGI from Robert's job and his small annuity Linda has is about $12,600. Half of their combined Social Security is over $22,000. That puts their provisional income at almost $35,000. Well, that's over the $32,000 limit for couples, which means, suddenly, up to half of their benefits are taxable. The result? They got hit with an unexpected federal tax bill of nearly $2,000. That almost completely wiped out all the extra money Robert had earned working part-time. And finally, let's meet Gerald. He's 73, a retired letter carrier. He did everything right. He's got his Social Security, a small pension from his years of service, and he takes regular distributions from his retirement savings plan, just like his financial advisor told him to. Well, Gerald's provisional income is over $41,000. As a single person, that puts him way over that highest threshold of $34,000. So, up to 85% of his Social Security benefits were subject to tax. He got a tax bill for over $3,800. He didn't have that kind of cash just lying around, so he had to set up an installment plan with the IRS, which, of course, means he's paying even more in fees and interest. Okay, I know those stories are a bit concerning, and that's understandable. But listen, the point isn't to frighten you, it's to inform you. So, what in the world can you do about all this? Let's get to the most important part of this whole America door, the 5 specific actions you can take right now to protect yourself and your money. Here it is. This is your action plan. Step 1, get your hands on your SSA 1099 form. Step 2, do the math and calculate your provisional income. Step 3, file a simple form to have taxes withheld automatically. Step 4, make your tax life easier by simplifying your payments. And Step 5, a really critical warning for married couples who file their taxes separately. We're going to touch on each one. For Step 2, calculating your provisional income. This is your official resource. It's called IRS Publication 915. Now, it looks long and official, but don't let that intimidate you. The worksheet you actually need is pretty straightforward. You can find the whole thing for free right on the IRS website. Now, this next step, this is a total game changer. If you do the math and realize you're probably going to owe taxes on your benefits, you don't have to just wait around for a big, concerning bill at the end of the year. You can have the taxes taken out automatically, right from your benefit check, just like when you had a paycheck. You just file this one simple form, the W-4V, and you can choose to withhold at 7, 10, 12, or 22%. This is a fantastic way to avoid that unpleasant surprise at tax time, and it can also save you from underpayment penalties. And please, pay close attention to this one. This is a massive tax trap for married couples. If you file your taxes jointly, your tax-free threshold starts at $32,000. But if you choose to file separately, that threshold drops to zero. Yes, you heard me right, $0. That means up to 85% of your benefits could be taxed starting from the very first dollar you receive. Now, I know a lot of couples file separately for perfectly good reasons, but many have no idea they are walking straight into this tax nightmare. And here are just a few other important tools to have in your back pocket. If your income drops significantly because of a life-changing event, you can use Form SSA 44 to potentially lower your Medicare premiums. Also, if you ever had to repay an overpayment to Social Security, make sure you claim the deduction or credit you're entitled to. And finally, if you decide not to do automatic withholding, you'll likely need to make quarterly estimated tax payments using Form 1040-S. Look, let's be realistic. This broken system probably isn't going to fix itself anytime soon. Those tax thresholds from 1993 are likely here to stay for a while. But here's the good news. You are not powerless. You now know the rules of the game. You know about provisional income, you know the forms, and you know the steps to take to protect the money you worked your entire life to earn. So, the only real question left is, what's your first move going to be?